So what you have in this diagram, you have the issues or the purpose of the documentation that is highlighted in blue and black at the top. Then you have the documents that enshrine the terms or the agreement of those issues. So you have an agreement that a finance document that lenders will prepare that is an equity support agreement. And then you would, and we'll talk about that in a bit. And that can take various forms, that equity, to do with equity support. Can take various forms. You would have security documents, which provides lenders security, that gives them security, basically what you call collateral security for the loans. So they call security documents. And then you would have the documents that would enshrine the accounts. Why do you need the accounts agreement? It is because you are going to be ring fencing the cash flows. So ring fencing is an important principle in project finance that you should have come across in the previous sessions. Ring fencing, it is the reason why you would typically have a special purpose vehicle that is created as the project company or the owner of the project and as the borrower to ensure that the sponsors do not commingle the project cash flows with their other businesses that they had. You don't borrow the money for this project and go and use it elsewhere. The lenders in project finance are financing that particular project and not anything else. Otherwise, it becomes corporate finance, in which case you have to post a corporate guarantee. And it then starts to move away from non-recourse or limited recourse. So some of the terminologies you would have come across in previous sessions are non-recourse / limited recourse. I had already that you did come across predictable cash flows. Those are important principles. Related to the principle of limited recourse, predictable cash flows is the requirement for ring fence. And I've mentioned that's why you have a special purpose. You set up a company whose sole purpose in life is to implement this project and not to do anything else but this project. And it's that vehicle, that corporate vehicle, that lenders will lend their debt into. And you also have to provide your equity support into. So that company will also have accounts for different things, bank accounts for different things. For example, you could have a disbursement account for the loans. The lenders will disburse in a particular account, the funds with that account, and from that account, you then move the funding into whatever. So you would have a tailored account that are for different purposes. So you have the service payment account. One of the things I had Femi talking about when I joined was the DSRA. What's the DSRA? Do you know what the DSRA is? Can you help us? What's the DSRA?
Debt service something account. I can't remember.
Reserve account.
Debt service reserve account. Thank you.
Exactly. So you are going to have a specific bank account for that purpose. So you could have a debt service payment account. You could have a debt service reserve account. You could also have a disbursement account for the debt. You would then typically have a revenues account or a collection account or both. Sometimes you will bifurcate the collection account from revenues account. Typically, it is when you have multiple bank, like if you have, say, a telecoms project or any other type of project where you have multiple customers, you may open several collection accounts in several banks. And then, so that people, your customers, end users, if you have one major off-taker, one main for the project, then you just need one revenue account or one collection account. You don't need two. But if you're dealing with end users, like a toll road or some other type of project where you have multiple end users who are all paying for the services that you're producing, that may warrant you opening an account savings and you open an account. First bank, you open a collection account, another collection account in Zenith, another collection account in Stanbic, and so on and so forth. You then have one revenues account, one or two revenues account, where periodically, maybe every week or every 2 days or every 3 days, you will sweep collections account into that revenues account. And from there, the money goes into a waterfall in terms of dealing with your OPEX, your CAPEX, operating expenditure. CAPEX is capital expenditure that you pay your EPC contractor and so forth. And then you could also now deal with your debt service payments. And then if you need to top up your debt service reserve account, or fund it if it's not fully funded, and so on and so forth. So you would have all of these separate accounts. You would also have an OPEX account where your operating expenditure is paid into, which you usually would have unfettered access into it until when you get to a default scenario. So the administration of those bank accounts is what gets enshrined in the accounts agreement. Sometimes it's even called an account management agreement or an account administration agreement, but simply put, account agreement. So it delineates your account structure. In some transactions, actually, where you are trying to simplify things, in some proper syndications, you would actually have a section of the syndicated facility agreements, which will be dedicated to the account structure. So you can actually bind everything into one single agreement. You just have an account structure, but in full-blown project finance, you will have the accounts agreement separate from the syndication facility agreement separate from the common terms agreement. And then you have the individual loan facility agreement. We've talked about that, which you would have in big financings. Everyone will have their own, or where you have a syndication within a project finance, within a consortium lending. You will have some which are in that multi-party syndication facility agreement, and the others who are not in that syndication having their own loan agreement. And then you would have the umbrella common terms agreement that is common to all of them. Then you can see two agreements at the bottom, the intercreditor agreement and the amendment waiver agreement. And you can see there's a link from the intercreditor agreement to the security documents. And there is also a link from the common terms from the CTA and from both the CTA and the loan facility agreement into the intercreditor agreement. So intercreditor agreement, as the name goes, is an agreement that is primarily between the lenders. The lender is a credit, so it's an interlender agreement. That agreement will be an agreement that regulates it. If you have junior and senior lenders in the project, sometimes in project finance or in consortium lending, you have senior and junior lenders. Sometimes the junior lenders are also regarded as mezzanine lenders. In a sense, a mezzanine facility is a facility that almost is like a blend of equity and debt. So it has some equity-like features, and then it still has debt, fundamental debt features. So it's usually longer tenured than senior debt, as all junior debt are usually longer tenured, and it also usually has, because it's higher risk, it also has a higher coupon than the senior debt. If in a stress scenario where you don't have sufficient cash, the senior lenders will be paid first before the junior lenders are paid. So you would have the regulating priority amongst the lenders, saying who is senior and what are the terms, and basically regulating decision making amongst the lenders. And it will also deal with sharing of security, because typically the senior lenders and junior lenders are sharing security, but in the security enforcement scenario, the senior lenders have to be paid first. So the junior lenders or the mezzanine lenders will acknowledge the superiority of the senior lenders in that intercreditor agreement.